Welcome to the Commerce Mentorship Program's online lecture series. My name is Richard and I'm the online tutor for Commerce 294, Managerial Accounting. Today we will be focusing on Part 2 of Relevant Decision Making, the last section of the course. By now, you should be familiar with segmented income statements, the scrap or keep decision, and the make or buy decision. I will begin by providing you with a brief overview of the subject matter, pointing out key formulas and tips that you will need to succeed in this topic. I will then guide you through some questions relevant to the course material. This is a good time to test your knowledge and understanding of the subject matter. Pause the video before I present the solution and attempt to complete the question on your own. You will know you have mastered the concepts presented when you are able to complete the questions independently. However, it is good to remember that you should not measure your success on this video alone. Accounting requires practice, and the more exercise you are able to complete from your textbook and from your instructor, the higher your likelihood of success in this course. At the end of this video, I will review our goals and objectives for today. Your job is to ensure that you have met each of these objectives and fully understand them. If you have any questions at any time during the video, make a note of it and speak to your instructor or teaching assistant. Not everyone will initially understand the concepts at hand, and you may find that you require some assistance. That is perfectly natural. By the end of this video, you should be able to systematically determine whether a company should sell a product or process it further. You should also be able to systematically determine whether a company should keep or drop a division, segment, or product line. Our first question type is the sell or process further scenario. Generally in this scenario type, a company is deciding whether to sell the product they already have or to process it further into another product. For example, a rice company could decide to either directly sell their rice to the consumer or process the rice into rice pudding before selling it to their consumers. In this scenario, you want to look at the extra revenue gained from processing the product further and weigh that against the extra costs incurred from processing. If the extra revenue derived outweighs the extra costs incurred, you know that the company should process it further. If the extra costs outweigh the extra revenue incurred, you know the company should sell it as is. Let's do an example. The Spicy Ricey Rice Company recently hired a consultant to determine the cause of the declining rice sales. Upon primary and secondary research, the consultant told the CEO that his company could become profitable again by further processing their rice into rice pudding. It currently costs Spicy Ricey $10 to create one bag of market-ready rice, based on $2 for pesticides, $5 for packaging costs, and $3 for direct labor costs. Spicy Ricey produces 10,000 bags of rice per year and sells each bag for $24. If Spicy Ricey processes its rice into rice pudding, it will need to purchase special grinding equipment that will cost them $40,000 semi-annually in rent. Each bag of rice requires an additional $3 in direct labor and $5 in ingredients to turn into rice pudding. However, each bag of rice produces 10 cups of rice pudding, and each cup of rice pudding sells for $2 per cup. The required question here is, should Spicy Ricey sell the rice as is, or process it further, as suggested by the consultant? As I mentioned before, the seller process further scenario involves comparing the extra revenue incurred with the extra costs incurred. Why don't we begin with the extra revenue incurred? As a reminder, each bag of rice produces 10 cups of rice pudding, and each cup of rice pudding sells for $2 per cup. In addition, Spicy Ricey produces 10,000 bags of rice per year. Based on this, the extra revenue of $2 per cup and 10 cups per bag and 10,000 bags produces revenues of $200,000. However, processing is not all good news. When we process the rice into rice pudding, we can no longer sell bags of rice on their own. As a reminder, Spicy Ricey produces 10,000 bags of rice for $24 each, and it costs $10 to create each bag. This creates a profit of $14 per bag. Multiply this by the 10,000 bags produced per year, and you get an outflow of $140,000. The net result of these two revenues is a $60,000 inflow. Now let's consider the extra costs. A reminder that if we process the rice further, we will need to purchase an extra piece of equipment that will cost us $80,000 per year. A reminder that the $40,000 rent is semi-annual, so we will require 2 payments per year. Each bag of rice also requires $3 in direct labor and $5 in ingredients to process into rice pudding. When we multiply this by the 10,000 bags of rice produced per year, we get $30,000 and $50,000 outflow per year. If we add up all these costs, we end up with a $160,000 outflow. Comparing the extra costs to the extra revenue obtained, we discover that the costs most definitely outweigh the benefits. In fact, we discover upon aggregation that there is a $100,000 outflow. As the result is negative, we should not process the rice further, and we should sell it as is. It would also be wise to fire your consultant. He's not very good at this job. Another relevant decision-making scenario we will be discussing today is the keep or drop scenario. In this scenario, we are asked to focus on a particular product line, segment, or division and determine whether to keep the segment or drop and eliminate it. For keep or drop questions, you want to either look for or prepare a segmented income statement. As a review, this requires you to conduct the following analysis for each product line, service, or segment. Sales revenue minus variable costs equals segment contribution margin minus direct fixed costs equals segment margin. This usually identifies a product or segment with a negative segment margin. These are the segments or product lines that you'll want to consider dropping from your operations. To determine whether it is worthwhile to drop a product line, compare the segment contribution margin, not the segment margin, to the direct fixed cost saved. Any segment contribution margin lost results in an outflow of cash, and any fixed costs saved result in an inflow of cash. Remember to ignore all common fixed costs and sunk costs. These cannot be recovered by dropping a segment. From there, you simply add the inflows and outflows together. If you get a positive result, you should keep the segment. If you get a negative result, you should drop the segment. Make sure you pay attention to qualitative issues. Will dropping the segment cause a loss of customers in other product or service lines? Will you have a large HR issue? Make sure you consider all the facts before coming to a conclusion. Let's do an example. Dr. Payne is a very talented man. He operates Dr. Payne's House of Soul, a large complex in downtown Vancouver where patients can come to fulfill their dental checkups, buy high-quality fish, and purchase insoles to cure their aching feet. A segmented income statement for his 3 products is shown on the next slide. Direct fixed expenses include depreciation on equipment of $40 for dental checkups, $10 for fish, and $40 for insoles. We have 2 requireds in this question. For the first required is, what impact on profit would result from dropping the fish outlet? Our second required is, 20% of patients who seek out Dr. Payne's dental services also have aching feet. If Dr. Payne drops his insole shop, 20% of dental patients will no longer feel it is necessary to head to Dr. Payne's downtown Vancouver complex and will take their business elsewhere. What impact on profit would result from dropping the insole shop? Let's begin with the impact of dropping the fish outlet. We want to look at the fish segment because it is generating a negative segment margin, according to our segmented income statement. Let's start by looking at the segment contribution margin loss. According to our segmented income statement, $12 was the segment contribution margin of the fish outlet. We now compare this to the $10 of direct expenses saved by dropping the fish segment. I bet you're wondering how the $20 magically turned into $10. A reminder that depreciation is a sunk cost that cannot be recovered by dropping a segment. It is therefore relevant to this decision. This creates a net result of negative $2, or a $2 outflow. This means that we should keep the fish segment, even though it is producing a negative segment margin. Looks can certainly be deceiving. What if Dr. Payne also loses patients in one of his other service lines? Again, compare segment contribution margin lost to direct fixed cost saved. If we drop the insole shop, we would lose the $30 segment contribution margin, but in return, we would gain the $10 direct fixed costs. In dropping the insole shop, we will also lose 20% of dental checkup customers, so we therefore lose out on the segment contribution margin of 20% of dental checkup customers, or $180. We do not lose the direct fixed expenses in this case, as we only have lost 20% of the segment, not the entire segment, and as such, direct fixed costs cannot be avoided. This generates a net result of $110 in the negatives, or an outflow of $110, telling us that we should not drop the insold shop. This concludes the second part of our online tutorial on relevant decision making. Let's review our objectives for today. By now, you should be able to systematically determine whether a company should sell a product or process it further, and systematically determine whether a company should keep or drop a division, segment, or product line. If you're unable to complete any of these objectives, now is a good time to re-watch this video, or complete more exercises related to this section. Remember that you retain 90% of what you learned by teaching someone else, so study groups can be a great idea for Commerce 294. For additional problems, please visit us online at cmp.cus.ca. If you have any additional questions, please consult your professor or teaching assistants. Thank you for listening.